Some have been hit hard by the COVID-induced financial crisis, some harder. In such a bleak scenario, everyone would have felt the need for some monetary cushion or savings to fall back on. Yes, everyone, including you, even if you were spared the painful pay cut or job loss. If this close call made you think that you do not need to focus as much on savings, well, stop. If you think that because the lockdown lowered your expenses and you don't need to put in as much effort to consciously save, stop too. Hold that thought, you may be treading the wrong path. Just ask yourself this: when do you think life will get back to its pre COVID hustle and bustle? Do you know for sure when COVID and the surrounding issues will come to an end? Your guess is probably just as good as ours. That is, we don't know when. Nobody does. Given just how uncertain the future is, to save more and spend less is the need of the hour, more than ever before. In this video, we will focus on various expenses in an average household and show you how you can cut back on spending on these. For starters, you just need to make a budget. This will help you keep tabs on all the outgoes. Number 1. Reduce the rent. For those living on rent, the struggle is real. Most have left town to go back to their hometowns but have to continue paying rents to hold the flat or room until normalcy resumes. Naturally, shifting back home is the most obvious way to reduce such expenditure and to save this cost. You don't know when offices will reopen, when work from home will end, etc. The other option is to request your landlord to reduce rent, even if temporarily. If your relationship with him or her is cordial, then it is worth all your effort to give this a shot. Experts point out that landlords too realize that getting new tenants in this situation is difficult, so there seems to be room for you to negotiate. But if your landlord does not budge, propose to pay less and get the amount adjusted against the security deposit you would have paid him initially. Number 2. Optimize credit card usage. If used to spend recklessly, credit cards can be a bane, but the same cards can be a boon and offer many benefits if used wisely. Since payment usually comes 15 days after the end of the credit cycle, the credit period for each purchase ranges from 15 to 45 days, right? So use this strategy. Decide how much you are planning to spend via cards and do it when the cycle starts so that you maximize the credit-free period. Got more cards than one? Allocate spending to these at the beginning of the cycle. Many offline and online stores offer discounts on particular types of cards or from particular banks on specific days. Now, of course, we're not saying you make unnecessary purchases just to avail these, but do check it out. Additionally, credit cards also give you reward points. See if these accumulated points can be used for purchases. Number 3. Cut interest costs. Those staying in their own homes usually have hefty housing loan EMIs to pay off. Other loans like car, education, personal loans, and credit card outstandings also add to the interest burden. So your first move should be to pay off all high-cost loans and debts. You can do this by redeeming some low-yielding investments. Assets like debt funds, arbitrage funds, etc. generate only around 6% returns. Liquidating jewelry lying idle at home is yet another option. Gold has gone on to cross the 50,000 mark, so monetizing it is a good idea. If you are unable to pay off high-cost debts, review the interest payable on these and take steps to cut that instead. For example, the high interest on your home loan may be because you are still stuck in an old interest rate regime like the MCLR. The gap between the one-year MCLR, an earlier proxy for home loans, and repo rate linked lending rate or RLLR is wide for many banks, as shown in the given picture. Bring down costs by shifting from the MCLR to RLLR regime. If your lender is unwilling to make the switch, shifting your loan to another bank or financial institution remains the only option for you. The interest rate difference between home loans and personal loans is also wide as shown. Most banks are offering home loan top-ups with interest rates like those of home loans. Replacing a Rs 5 lakh personal loan with a 5-year tenure and a 13% interest with a home top-up loan of same tenure and 8% interest can result in you saving Rs 1.88 lakhs. Number 4. Hang up on those high telecom bills. One positive development from price wars between telecom companies is that your phone bill would have come down substantially. But if it hasn't, then that's a cause for concern. Check what's holding you up. Check if you're stuck with very old plans. If you're not spending on commute, well, you're certainly spending more on utility bills such as electricity, phone, internet, Wi Fi data, etc. This is all because of work from home. Then there is the subscription based home entertainment like Amazon Prime, Netflix, etc. No one is asking you to give up on these, but to save, trim the bouquet of service providers. Stick to those that you use regularly and discard the rest. When it comes to phone and broadband, convert individual plans to family plans as shown. Telcos offer family plans that are much cheaper than individual plans. And finally, number 5, spring clean your insurance portfolio. Insurance and adequate coverage are of utmost importance right now, but while protecting yourself and your loved ones, here's how you can be smart about it. Cut insurance costs by shifting from costly endowment plans and old generation ULIPs to pure term plans. Thus, by saving substantially, you can also increase your coverage with the extra money. For term plans, avoid the return of premium plans because they are also costly. However, you need to be careful because the exit costs of traditional plans are huge. But what if you have been paying a premium for the last 10 to 15 years and the surrender value is still low? Experts say that the best option is to make the plan fully paid up and stop paying any more premium when the exit cost is very high. When comparing the cost of pure term plans now and that of a term plan with the return of premium or ROP, shift from the latter to the former only if you have taken an ROP plan recently. Since term plan premiums go up with age, you may not save in premium if the ROP was taken many years back, say experts. In addition to the above mentioned tips, you can also do the following. Go the generic way to save money in terms of your basic expenses, apply the 10-day rule to your shopping urges, and slash the mutual fund ratio. Find out how to do these in the full story on our page. That's all from us for now in this video. Stay healthy and safe. Stay tuned with us for more tips on saving and spending.